Welcome back, everyone. This is the video that I have been waiting all this time to finally make. This is the end game, you can call it, of this investing series, where I take all of the information and all the past references and all the information from the previous videos in this playlist and culminate it all here into one video that explains my investing process as well as how I evaluate mutual funds and compare things, and just kind of give you guys just a little overview on how I think about a lot of this stuff. And the way I'm going to be doing this is I use what I call the great equalizer. It's called Morningstar, and I'm going to show you how to use Morningstar and look at the different parts of the funds that are important to me. And before I start off, I have to do this quick disclaimer. I am not a financial advisor, nor do I want to be one. I am not legally allowed to tell you what to buy, what not to buy. The funds that I'm going to be using as comparison tools are just for comparison tools to show what to look for. I am not suggesting what you should buy and what you shouldn't buy. It's all totally up to you. There are four main things that I look for in mutual funds. And you can kind of think of them as like vital signs. Like, you know, when you go to the doctor and they take your heart rate, your pulse, your blood pressure, temperature, all that kind of stuff. Those are your vitals. And there are four vitals that I look for in a mutual fund specifically. They are the income and growth potential, the expenses and the fees, the volatility, and the exposure. And I'm going to show you where to find these on the Morningstar website for any fund that you put in and how to evaluate those at the end. So this is Morningstar, as you can see right up in here. And the only real thing I want you to take a note of, the first thing when you log into this page, is you'll notice these three markings down here. These three right here, the DJIA, the S&P 500, and the NASDAQ, these are those three main indexes that I was talking about in the video on index funds. The Dow Jones Industrial Average, which is just like the top 30 big company, the biggest top 30 companies in the United States. The S&P 500 are the top 500 companies that are traded on the New York Stock Exchange, and the NASDAQ focuses mostly on those technology-based and new upcoming companies. There's about 3,000 or so in that. So what I do is I'll go up into this search quotes site right over here, and the first fund that I'm going to take a look at is called AMRMX, the American Mutual Fund A. Now there's a lot of information that's coming right at you on this first page. But I'll kind of walk you through what I look for when I'm looking at mutual funds. So what I'm going to do, I'm going to start off right up here, and I'm going to take a look at the Performance tab. Now this is a graph on the overall performance of how this fund is done. The blue line is the actual fund performance. The yellow is the category, or how it's done compared to its peers. And the purplish kind of pink line is the index that it's actually trying to follow. And this is the growth on it. Right? That's why it says under here returns. This is the actual growth on this fund. Now if you scroll down, you can see this is the actual return for each of these years. This is how it's done up to date. Right? But what's really important is this trailing returns right down here. This is the total percentage for the last 10 years, how it's done. On average, it's done about 11.21%. What I look for is the 15-year return, because the 15-year return accounts for the 2008, 2009 drop, and it also accounts for the last 10 years that we've been doing really well. So the 15-year is giving you a very good indication of how well this fund has performed during a good market and during a bad market. Next thing to take a look at, if we scroll up, see how it says returns right over here under performance? If I click distributions, these are your dividends. This income right here, this is your dividend column. Imagine there's dollar signs right in front of all of these. So this would be about 20 cents, and this would be per share of this mutual fund that you own. So if you owned 100 shares of this, in June 14th, back in June 14th, you would have gotten 20 bucks. Okay, and you'll notice that they send these out and distribute them roughly every 3 months or so, which is every quarter of the year. Let's go back over to quote. This is like the main overall summary. And if you look right here under this investment style, it says large and blend. Large means it's focusing on a lot of the large companies. We're talking the Facebook, Amazon, Microsoft, Google, those kind of companies, big dinosaur companies. The blend means that it uses a combination of growth and income. So it's growing, it's using companies that are growing, so you have things like Apple in there, but it's also using companies possibly like maybe Coca-Cola, which are distributing dividends, which is what you saw before. If this was just a growth and all it cared about was just companies that were growing, it would say large, and that would say growth on it. Okay, right? If this was focusing primarily on income or dividends, it would say large value. Another thing to take a look at when dealing with dividends is this SEC yield. Now, this just means this is the percent, the dividend yield for the last 30 days. I don't really like this because I prefer if it would give me the dividend yield for the last year. And it used to do that, but the Morningstar changed their format. But we'll use this for right now. But this is kind of like 1.72% is the amount of dividend yield that you would get. So anything between, say, 0 and 1 is low. Anything roughly, over 1 to, say, 1.5 is medium-ish. Or actually maybe between 1 to even maybe 2% is about medium. And then anything over 2% dividend yield would be generally considered more focused on income as opposed to growth. So here's how to find where all of the expenses are. The first big one is this one right here, the expense ratio. It's at 0.57%. Now this is an annual fee, so if you add, say, like $1,000 in this fund, this would be about $5.70 per year for every $1,000 you had invested. Next is load. This generally is going to be a front load right here, so you would pay this right up front. So for every $100, you would pay $5.75 every time you invested $100. Here's the turnover percentage. This percentage represents the percentage of the portfolio that is getting replaced every year. So unlike like the percentage right here and the percentage right here, which represents an amount of investments, this percentage represents the amount of the portfolio that the fund managers are replacing every year. And the higher this is, the more frequently they're doing this, the more fees that you, the investor, are going to have to pay. If we click over here on portfolio, so this just kind of shows what the fund is invested in. It has a bunch of U.S. equity, has a little bit of non-U.S. equity, but the important thing I want you to note here is this cash right down here. The fund is reserving 12.88% in cash reserves. This is the money that is not being invested and is being held on the side as kind of like a little baby emergency fund to take care of any expenses that the fund itself might actually accrue throughout the year. So for every $100, that's $12.88 that's sitting on the sidelines not doing anything. So let's do an example here where let's just throw in $100 and you're going to invest $100. So that means that $5.75 comes right off the top from the front load. So right now you're down to $94.25. Of that, 12.88% is going to go towards cash reserves. So the math is that's going to be about $12.14 goes to reserves, which is going to end up leaving you with about $82.11 actually going to work for you. Now, you have to factor in your expense ratio and your turnover fees, and your returns are going to be even less. And let's even just go ahead and say that if this money was in a taxable account, meaning it wasn't in any kind of like a Roth IRA or 401k or anything like that where it was sheltered from the taxes, there's even less returns for you because those are now going to be working against you. So you can see how even that $100 ends up not performing as well as you originally may have thought once you factor in all of these fees and all of these tiny little drags on your returns. Going back up here, we're going to click on risk. Now I can go between the last 3 years, I can look at the last 5 years, or I'm going to look at the last 10 years. I'm going to look at the last 10 years. And here you can see this number right here, which is what's called the Sharpe ratio. This is that ratio that I was talking about that basically is the returns relative to how much volatility you have, or how much, the number on the bottom that they're using is really the standard deviation, but it's how good of a return you're getting relative to how much risk or how consistently the fund is able to maintain that over that last 10 years. So really quick, if we look back over here on the performance, and over the last 10 years, it did 11.21. Okay, if we look at the total fund return right here, this is kind of the last 10 years if you think about it. You can see it's kind of varied. All right, it did pretty good here at the beginning, but then in 2011 it dropped to 4. All right, it was at 25, 12, then it went to 4, then it went 12, then almost 28, then back down to 12, then in 2015 it went down to -2. Right? So it varies wildly, but if you kind of average it out over these last 10 years, it's been about 11.21. Now, you see how it's not consistent about 11.21? It's not really consistent on that. That inconsistency is what volatility is measuring. So back to risk. And the higher this Sharpe ratio, the better the fund has done. The more consistently it's been able to return that specific 11%, whatever it was, to its investors. And this also assumes reinvested dividends. Generally, a Sharpe ratio larger than 1 is usually pretty good. 1 is about average, and anything less than 1 usually indicates that you were probably better off putting your money maybe in a savings account, and you would have gotten better that way, just due to the volatility nature of the fund. And the last bit is to click on Portfolio. So again, you can see what the asset allocation is. Specifically, I really just look at cash, but down here it shows you what it's actually exposed to. So there's quite a bit of financial services. There's a little bit of real estate. It's got some technology, some energy. But the real important aspect is that you can look down here and actually see some of the companies that the fund is holding. Now let's look at another fund, specifically VTSAX. Now this is also another large blend fund, and let's look at its performance. Now what you probably notice is that it almost looks like you can see that the fund line doesn't even seem to be here. It looks like there's only this purple pinkish line right here. And that's because this is an index fund. This is a passively managed index fund, and it is tracing and following the index almost perfectly. Unlike, if we look back at AMRMX, you'll notice that at sometimes it's doing well, like up here, the fund is beating the index, but then down here, it wasn't beating the index. Vanguard doesn't do that. The Vanguard VTSAX doesn't do that. It's tracing the index exactly. That's what I mean. It's whatever's in this fund is designed to follow the index exactly. You won't do any better than the index, but you also won't do any worse. Right? And also, if we take a look at the distributions, here's what it's been generally paying out. If we look down on the trailing returns, it's been about 13.18 for the last 10 years. But again, I like to look at the 15-year because that tells me how this has been performing in good and bad markets. Okay. Back up to quote. Okay. Have a look at this expense ratio. 0.04 as opposed to 0.57 where it was before. So it's much, much cheaper than it was before. There is no load on this. So it's free to buy from a broker, specifically if you buy it from Vanguard. SEC yield is not too bad. It's got some dividends. And have a look at your turnover. All right, 3%. In other words, only 3% of this fund is replaced every year. So way fewer fees on that one. and have a look at the cash reserves. 0.77%. So for every $100 that you invest, 77 cents will be set aside. Sharpe ratio is just at 1. This is what it's exposed to, a lot of technology, a little bit of real estate, some financial services. What I generally like to look at are the actual holdings. And a lot of times for this, I will actually go to Vanguard's website and see what companies are listed, because that will give a full listing as opposed to this truncated list. Here. This is the T. Rowe Price Science and Technology Fund. This is another fund. Now, this is another investment style. This is large growth. And as you can see, they don't have dividends, right? Because this is purely based on growth companies and companies that are reinvesting their profits back into themselves. So I'm going to start out with performance. The fund has done actually pretty well. It's beaten out its peers and its respective index pretty consistently. We go down to the 15-year return. 11.25 is not bad. It's above average. And the last 10 years, it's done 16.19. Pretty good. Here's the expense ratio. So among the 3 funds that I've shown so far, this is the most expensive. There is no load, which is pretty good. But look at this turnover right here. 109% of that portfolio. So basically, the entire portfolio gets a facelift every single year and then some. Right? And every single time that a share of a company that is in this fund is bought and sold, you're paying a fee for that. That's called a transaction fee. So that turnover percentage is incredible. All right? Which probably explains the good returns that it's been having. Okay? That would explain why it's as good as it's been doing. All right? It's pretty, I mean, year to date, as of right now, it's almost 37%. But at what cost? How much is that really costing you? Because unfortunately, when it comes to turnover, we don't, as the investors, don't know what the actual number is. We can't calculate that. All we know is 109% of the fund has been replaced. And there is $8.56 per every $100 saved in reserves. And if we look down here, you can see that it's pretty much all technology, which makes sense. This is a science and technology company, and some consumer companies as well. Here's what it's focusing on. Nvidia, Microsoft, Facebook, a lot of these companies do not give dividends. They reinvest back into their own companies. The Sharpe ratio is 0.94. So that indicates to me that the fund is a little more volatile than a regular, say, index fund, or just even a regular fund within its category. So this is kind of a little quick spreadsheet that I put together that summarizes the 3 funds that I looked at today. So it has these 3 funds up here, and I'm looking at the 10-year growth. Normally I look at 15-year growth, but because I can only go to the 10-year Sharpe ratio, I need to be consistent with my time frame. So these are the returns up in here in green. All the reds are the expenses, and down here is the Sharpe ratio, which counts for all the volatility. And what's interesting to look at is pure SCX had the highest returns among all these. It had over a 3% return compared to VTSAX within the last 10 years. But it was the most inconsistent. Not by much, but it had the lowest Sharpe ratio. Now, again, I'm not saying that you can compare all these apples to apples. Okay, these two are large blend funds, and this was a large growth fund. So you don't want to compare those apples to apples, but just to kind of get an idea of how these numbers work together. This had the highest returns, but it had the highest volatility, and it was also the most expensive. So what these fees are doing, all of these fees for any of the fund, they are paying to get these as high as possible, also while getting this as high as possible. So the ratio works out to be the returns divided by the risk. And what these fees are supposed to do is get you the highest return with the lowest amount of risk. And I don't know if that's really happening right here. You know, yes, it has the highest returns, but is it really worth the risk? Can you really stomach that? Over the next 10 years, will this
fund be able to perform this well? I don't know. And is it going to be worth whatever these fees are going to be? See, this is how you have to think like an investor. Is the risk worth it? Or is it better to go with lower fees, with a lower return that might be more consistent? Now, AMRMX is kind of middle of the road. It has the lowest return, but it also is the most consistent. Also, though, it has the highest cash drag. So this is how you want to weigh out your options. Now, the last thing I want to go over is what is known as exposure. So let's take a look at one fund. These are different types. These are kind of like index funds. These are called exchange traded funds. I'll go over these maybe a little bit later on. But this is a Vanguard fund called VOO, and this is another Vanguard fund called VTI. All right, and VTI is kind of like, it's almost very, very similar to VTSAX. I have seen portfolios where there are people that literally have both of these funds in their portfolios at Vanguard. What I've shown here is all these companies that you're seeing. This is a list of all the companies that are in these respective funds. And what I did is I selected this and this. And what I did is I went under conditional formatting, highlighting rules, and I go duplicate values. And what this shows me is all, and what's going to do is it highlights all of the, anytime there's a duplicate that shows up in both of these two columns. And as you will see, anything that's highlighted in pink shows up in both of these funds. Okay, this one doesn't. ServiceNow. Tesla's not in VOO. But keep going down, keep going down. Look at all these. I mean, look at all these reds. These are all duplicate companies. All right, there's a couple. Now we're starting to get a little bit more, but not by much. You keep going down, keep going down, keep going down. Da 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 da. All right, and then at this point, I stopped copying because you can only do 10 at a time. I stopped copying what was going on. But look at all of these companies that are shared between these two funds. It is redundant to hold both of these in your portfolio, because the problem is redundancy in a portfolio is bad. Okay, if one of these funds tanks for whatever reason, the other one will too. All you're doing is adding extra funds, and you're paying the extra fees for whatever is happening with the other. So if you own VTI and you buy VOO, you're not going to pay all the extra fees and everything going on with VOO. You don't want redundancy in a portfolio. You want diversification. What you should do if you want VTI is then say add an international fund, or if you want to add some real estate in there or something like that, or you want to add some more dividend paying stocks, go ahead and do that. But don't duplicate your holdings and your positions.
Hope you enjoyed that. I know it was a little bit of a longer video, but it's endgame, so I have a lot of loose ends to tie up. If you have any questions or comments, go ahead and leave them down in the section below, and I'll go ahead and talk with you guys later. See ya.